Cameras on.
Thank you. Good morning, everyone.
Good morning.
It's a little weak. Good morning, everyone. Much better, thank you. Welcome to the New York City Retirement System's Common Investment Meeting for February 6th, 2019. It's our first meeting of 2019, so let me wish you all Happy New Year. And we will start by calling the rolls for each system. Let's start with fire. Mr. Dunn.
Good morning, John.
Good morning.
For Mayor de Blasio.
Cynthia Collins.
For Comptroller Scott Stringer.
John Dorsey.
For Commissioner of Finance Jacques Jiha. For the UFA, Mr. Gerard Fitzgerald.
Leroy McGinnis with Gerard's proxy.
Mr. Leroy McGinnis.
Present.
Mr. Edward Brown.
Present.
Mr. John Kelly.
Eddie Brown with John Kelly's proxy.
Mr. Peter DeVita.
Present.
And for the UFOA, Mr. Jack Kelty. Mr. Liam Guilfoyle. Mr. Paul Mannix. Here. And for Fire Commissioner Daniel Nigro.
Terrell Brown.
We have a quorum.
Thank you, Pat. Let's next move to police. Is Kevin here? It's Mr. Sens.
Kevin will be coming.
Okay, go ahead, Bob.
All right, roll call for the mayor.
Go ahead.
Schumann Ray for
Mayor Bill de Blasio.
Commissioner of Finance.
All right, John Adler for Commissioner of Finance, Jacques Jiha.
Controller.
John Dorsey, designee for Controller Scott Stringer.
Police Commissioner.
James Conroy by proxy for Stephanie Zimberg, designee of the Police Commissioner.
PBA.
Pat Hendry, PBA.
SBA.
Anthony Bradley, designee for Admirals.
LBA.
Lou Turco.
CEA.
Lou Turco's got the proxy for Roy Richter.
And the DEA will be coming shortly, Mr. Facilitator. We have a quorum.
Okay, thank you, Mr. Sendkesta. Excuse me. Let's next move to teachers. Patricia Riley?
John Adler.
I am here.
Thomas Brown.
Here.
David Kazansky.
Present.
Lindsay Oates. Deborah Penny. Susanna Vickers.
Here.
We have a quorum.
Thank you, Patricia. And NICERS, Melanie Winery.
Chair, Mayor's Office.
John Adler, present.
Comptroller's Office. Here. Public Advocate's Office.
Corey Johnson, acting public advocate here.
Borough President Manhattan. Borough President Brooklyn. Borough President Bronx. Borough President Queens. Borough President Staten Island.
Isaac Gorodetsky for Borough President James Otto.
International Brotherhood of Teamsters.
Ruben Torres for Teamsters Local 237, Gregory Floyd, President.
Transport Workers Union.
Dave Katzman for TW Local 100 President, Tony Otano.
District Council 37.
Ray Santander for DC 37, Executive Director Henry Garrido.
We have a quorum.
Thank you, Melanie. And for BRRS, Sandy Rich.
Morning, Mr. Adler.
Good morning.
We're represented here today by Natalie Green-Giles, our trustee, and we do not have quorum, and we'll administer this business at our next board meeting, February 27th.
Thank you, Mr. Rich. Let me just welcome Speaker Johnson, the acting public advocate. I believe this is your first common investment meeting, so welcome to the meeting. Any other new trustees?
Joe Alejandro, PBA.
Oh, Joe Alejandro, welcome. And I'd also like to welcome Mr. James Conroy, who is filling in last minute for Stephanie Zimberg as the police commissioner's representative. Welcome. Anybody else here for the first time? Okay, great. So let's take it away. Let me just go over the schedule. We're going to do our common business up here, starting with a public session, and then we'll go into executive session. We will have, after the presentations and discussions are done, we'll have lunch up here on the 10th floor. Then there will be police and fire business up here on the 10th floor. Everyone else will go downstairs to the 8th floor to caucus, and we'll, conclude in the caucus rooms by reporting out into public session. Okay, and with that, I think I'm going to call up call up Alex Donier to begin our presentations.
Good morning. I was going to mention that given the market swings we've all witnessed from the last time we got together in December, we've decided to move our market overview to today's meeting, and Mike Haddad will be presenting the market overview of the fourth quarter and certainly January into the first week of February. So with that, I'll turn it to Michael Haddad.
Thanks, Alex. So as usual, I'm going to spend my time with you talking about public market returns for the fourth quarter, attempt to put a narrative around that, which is a challenge given the volatility and the reversal in markets, and then spend time on current market themes, and most importantly, tie the concerns in markets into your portfolios and talk about your actual asset allocation as of today. So before we jump into the actual numbers, I'm just going to preview this with December. The S&P 500 was down 9.2%, and the worst December since 1931. So with that preview, I think you kind of have a flavor of what Q4 looked like. I would draw your attention to the third column here in the fourth quarter, and you can see all three equity indices that are benchmarks for your portfolio were down hard in the fourth quarter, with U.S. leading the way down 14%. In government bonds, we had a meaningful rally in the fourth quarter with 30-year yields down 40 basis points. That resulted in positive returns for the treasury components of your portfolio. But unfortunately, in sympathy with the down equity markets, credit spreads widened quite a bit, with investment grade wider by almost 40 basis points in the fourth quarter and high yield wider by almost 300 basis points. So slightly positive return with investment grade, but high yield was down hard. So a couple takeaways from this slide was the negative correlation of returns between equities and fixed income. So that functioned the way that we had hoped to in extreme volatility. And then the second takeaway, I'd say I draw your eyes to the 3-year column. Shout out to Rokutan. The 3-year column. So in U.S. equities, when I was in front of you last month talking about that number was 17%. So I just wanted to show you that what one bad quarter can do to compounded returns over time. And going forward, we're going to live with this bad quarter for quite a while. So with that being said, there's no one specific catalyst for what happened in the fourth quarter. I think there's a variety of them. So I've tried to list, in my mind, what was most important. So I'm going to spend most time on the top 3 and then kind of go through the other 4 more quickly. So slowing global growth was first and foremost. So as a backdrop, Europe in 17 grew around 2.4%. In 18, probably less than 2. And in 19, it's probably going to grow closer to 1.5%. So within Europe, Germany had a negative GDP quarter in Q3. That was due mostly to some changeover in auto emissions in the European continent. But that spilled over in the fourth quarter, and the trade tariff and the slowing in China certainly had an impact on Germany. France, as we all know, is going through a whole series of protests around a variety of things, and that's without doubt has slowed growth in France. And Italy is still fighting their deficit issues and how to deal with that going forward. And just this week, Italy posted a negative GDP number for Q4, so that's 2 in a row, and that technically qualifies as a recession. So Italy is officially in recession. And in China's undergoing this delicate balance of trying to de-lever their economy very slowly, but at the same time not let growth get away too far to the downside. So on one hand, you have China as a whole trying to de-lever. On the other hand, you have them trying to keep growth, from going too far below their targets through some monetary stimulus. But net China is slowing. The second part, equity earnings and valuations was a big contributor to the fourth quarter. And I've listed the Apple announcement because this, to me, was one of the catalysts in early November, and which seems like ancient history now. But as a reminder, what they pre-announced their earnings. Earnings were okay, but what was alarming is they talked about revenues for 2019, and they specifically mentioned slower iPhone sales, specifically in China. So it triggered a market view that the combination of the China slowdown and the trade tariffs were going to be damaging to U.S. businesses going forward, and it kind of spilled into all things China in that whole fourth quarter environment. I can't ignore the Fed. In December 19th, the Fed had their FOMC meeting. They raised rates 25 basis points as expected. They downgraded their rate hike expectations for 19 from 3 to 2, but they still anticipated more hikes as of December 19th. And in the press conference, when asked about quantitative tightening, said differently, balance sheet contraction. Powell gave kind of a glib answer and said it's on autopilot. So that the combination of what seemed to be on December 19th, the Fed ignoring what was going on in financial markets, I think contributed to the extreme volatility in December. And then on top of that, credit was widening. We talked before about what happened with General Electric and Pacific Gas. And the markets were wrestling whether that was idiosyncratic to those two companies or just the tip of the iceberg on credit concerns. And reluctantly, I had to include what's going on in Washington. While it remains a circus of sorts, it actually really bothered markets in the fourth quarter. Starting with the midterm elections. So that was a change in the House from Republicans to Democrats. And from a market perspective, that just means the end of the Republican agenda, if you will, in a market-friendly way, specifically additional deregulation. So I think the markets kind of realized there's going to be less deregulation going forward with the Democrats in check. And the China trade negotiations, we're more in a positive way in the fourth quarter because of the G20 in Argentina, where it seemed that Trump and Xi reached some type of détente, if you will. But the uncertainty still remained, and you layer that on top of the Apple announcement, and it led to a lot of uncertainty. And then lastly, with the government shutdown, and again, I'm trying to stay away from the political aspects of that, it slows growth. It just is what it is, and the uncertainty in December was at its peak, and that also mattered to markets. On top of that, oil was down 30% in the fourth quarter. A couple different reasons as to that, but what the takeaway I want to share is the U.S. is now net neutral in oil, meaning what we import versus what we export. So while lower oil prices help consumers just by lowering their cost of goods, it damages the companies who either own reserves or who are drilling for reserves. So it's no longer a uniform positive for the equity market if oil goes down. And then lastly, all these things happened a lot of these things happened in late December when market conditions were extraordinarily illiquid. For example, leveraged loans were down almost 7 points as you measure a loan, from 100 down to 93. Just very, very illiquid market conditions with some trades trying to get done, and it just exacerbated the volatility. And I would say that is a lot of it's reversed itself in January. You've seen V-shaped recoveries on a lot of different things, but some of that had to do with illiquidity. Let me pause there before I go into current markets for any questions or comments on Q4.
Questions for Mike on fourth quarter? Mr. Santander.
Hi, Mike.
Into your mic, please.
Hi. Our corporate profits, were they artificially boosted because of the corporate tax cuts in the prior year? So in comparison, a year later, they might be lower correspondingly, and did that have an impact?
Yes, I have some specifics on that in a slide going forward, but to answer your question, in 2018, profits grew on a percentage basis compared to 17, up 22%. Wow. And then in 19, the growth is going to be more like 7%, so a decelerating pace, with 10% of that points being just the drop in corporate tax rate.
Which is basically it's a one-shot.
It is a one-shot on a year-over-year comparison, but it does help their cash flow permanently.
Right. Okay. Thank you.
Any other questions for Mike? Mike, just one question. Is it true that there was no high-yield issuance in the month of December? And isn't that like the first time in a long time? Or am I wrong about both of those?
I think you're right. Wesley, are you back there somewhere? It's true? Okay. Yes, nothing was issued, yeah. And spreads were 300 wider.
Okay.
So I gave you the scare tactic in about December, so let me give you the good news in January. The S&P was up 7.5%, or almost 8% in January alone. And the factoid, the best January since another ominous year, 1987. So what are markets focused on now? And a lot of the same things they were focused on December, but there is the news is not as worse as what was feared in December. So let's start with equity earnings and valuations and right to raise points. So the earnings season started the second week in January. About 40% of the S&P 500 has reported, and earnings have been much better than feared and probably slightly better than expected for 18. Where the concern has been on the 19 guidance, and that has been tempered by a lot of firms who have exposure to China or have exposure to Europe. Specifically with what's reported so far, the banks reported fantastic earnings. A couple of the big mega tech stocks reported very strong earnings. A couple of them missed a little bit. And then most importantly, like I said, the companies with China exposures, think Caterpillar, think Samsung, think NVIDIA, think even Jaguar, Range Rover. They all missed, and they've also reported concerns about 2019. So what's that resulted in on the table on the left is the earnings expectations for 2019 have been revised. These are consensus kind of earnings from 178 to 173, and that the growth rate then obviously gets downgraded as well. So Ray, to your question, you can kind of see the growth rate in the third column on that table, and it's a decelerating pace going into 19, even if you X out the tax cut. And equity markets do not like. They like positive earnings growth, but they do not like decelerating growth, and that ties into the second table, which is the PE multiple. So what I've showed here across the horizontal axis is PE ratios, so 14 through 17, and on the left-hand side, the middle row is consensus earnings, and then I just shocked it up 10% and down 10%, just to give some sense of where the markets might, be able to travel to as we're in this period of uncertainty. So as of this morning, the S&P is at 2732. So if you use the consensus earnings, we're kind of approaching 16 times earnings. And then just to give you some perspective on the forward price earnings ratio over the last 10 years, that's what this slide is intended to do. So where does 16 fall in that graph? I think it's in the eye of who reads the graph. Certainly, it's not as extreme as it was in 17 or as 11. To me, it's slightly above average. And then I guess I would say, given all the uncertainties facing markets, I would argue downside risk to the consensus earnings due to slowing growth, due to higher costs, that there's downside risk to that number. And just all the factors facing markets, I would think of the PE ratio can't get a whole lot above 16, maybe 17. Back to the Fed. So the Fed met on January 30th, a week ago, and a significant shift in monetary policy from the Fed. So as you know, the Fed meets 8 times a year. They issue an FOMC statement with that, and that statement it captures a whole lot of information. And what's changed this year is Powell's going to have a press conference after every meeting, and that's different from what was under the Yellen and Bernanke regime. So the first one I've listed on here is the future change in Fed funds, and this was a big change in what they did. And I tried to show you the comparison between December and January. And in January, they used the word patient, which in Fed jargon means 6 months. They also changed the word from increases to adjustments. I'll defer to the teachers in the room, but it's a very different meaning. Adjustments means up or down. And the fact that the Fed could say that with the unemployment where it is, and again, markets had rebounded by January 30th, so that panic was now out of markets, but that's a meaningful shift. The second thing was a change in what he said in the press conference about patience. And I've put the keywords up here. And so what he's really saying is that growth itself is not strong, is not the impetus to raise rates anymore. It's got to be inflation. Inflation lags the economy. The numbers we look at are year over year, and just by definition, that's a lagging number as well. So this is, in essence, he's not acknowledging the link between growth and inflation. So he's acknowledging the Phillips curve is flat, that there might be scarce resources, there might be technological things at work, and that he actually needs to see inflation before he wants to raise rates anymore. So again, that kind of gets into, has the Fed shifted to an inflation targeting regime? And what does that mean? That would mean that they want inflation around a target of 2%. We've been under it for several years now, and they might tolerate inflation over 2% for some period of time. And importantly, if they don't get it, will they ease in order to get inflation up? And that's what ties into that word adjustments. And the last part was on balance sheet policy. So they confirmed that they are going to leave excess reserves in the system in order to conduct monetary policy. And if you back out some of that data, it means the balance sheet is going to shrink to probably between $3.5 and $3.75 trillion, and we're slightly under $4 trillion. So what does that mean? That means balance sheet reduction is going to probably end sometime in the second half of 19 or the beginning of 20. And that is clarity that the market didn't have before, that it can now start trying to discount and think about the end of quantitative tightening in the U.S. Secondly, and they did a separate press release on balance sheet policy, and I put the keywords on the slide. But now they're acknowledging they're going to use the balance sheet as a tool in monetary policy. So they're going to mess with the size or the composition of the balance sheet, if they get to the point where they need to do it. And that, again, is clarity with the Fed. So as we think about markets, if there is a slowdown, if this cycle ever does come to an end, they're probably going to lower rates somewhere down near zero. And if that doesn't do enough, then they're going to either increase the size of the balance sheet or change the composition of it. What I mean by that, they'll probably extend duration with their Treasury portfolio if they get to that point. So this has implications for a lot of different asset classes. Starting with just the Treasury market, it probably means a steeper yield curve, lower yields in the front end, because we have to think about the probability of a cut as well as the probability of a hike. It's not real clear what it means for the back end. If the Fed is going to tolerate higher inflation, all things being equal, that's not good for long duration fixed income. It just erodes your returns with inflation.
Oh, thank you. Sorry, Mike.
Glad to help. Guess you didn't like my Fed review. And just as an example, I wanted to share with you this one graph. So this is a graph of Jan 2020 Fed funds futures, and this one contract encaptures what the market is expecting in terms of Fed policy for all of 2019. So extreme volatility during December. So if you look at the lows of this contract, right around 97.05, what that implies is a Fed funds rate of 3%, so additional 2.5 hikes over the one they did in December. Contrast that with the high of that contract, which is around 97.85, which we reached in early January, and that implies a 50% probability of a rate cut. So that's almost a 75 basis point change in market expectations of Fed policy in 2019. Pretty extreme for a short period of time. So the U.S.-China trade negotiations remain very important in markets' eyes. So where are we now in this? I think Lighthizer and Mnuchin are due to go to China at the end of the month. There still is no clarity on whether Trump and President Xi are going to meet. It's kind of expected to do that. But what I just wanted to share with you is from a Chinese markets perspective, things have been stable since November. And maybe that coincides with the détente from Argentina. But the graph on the left shows you the Chinese currency. Lower on that chart means the Chinese currency is stronger versus the dollar. So you can see that's rallied almost 3% from the lows in the fall. The chart on the right is the Chinese equity market, the A shares. And in contrast to the U.S. equity market, it was going down all year. And it is stabilized near its lows, since the fall. So from a Chinese market perspective, there's some stability showing there. And then lastly, volatility. Volatility is likely to be higher than what we've experienced over the past several years. So this graph is the VIX index. So this is the 3-month volatility on the S&P futures. And you can see some spikes throughout the past few years. But where we've kind of, in the last half of the year, have moved to a higher volatility regime. And I would expect this to continue. All things being equal, higher volatility is not good for financial assets. So given those concerns, what are the concerns that we have about your portfolios? So I would say U.S. equities, we're still concerned. When you think about downside risk to consensus earnings, when you think about a multiple of around 16 now, it just kind of speaks to me that there's limited upside from here, and it's not an asset class that I think is going to return anywhere near what we've seen over the past several years. The Treasury portfolio, the duration becomes a very critical component as well, given the change in monetary policy, potential change in monetary policy. And then as one of the trustees reminded me this morning, is Powell going to flip again? Because we've seen Powell change very quickly in a short period of time. I would argue not. The use of the word patient in the FOMC statement is meaningful, and it's somewhere in a 3 to 6 month time period. So I think that the Fed is going to be out of the picture for at least that time period. And we remain concerned about wider credit spreads. Leverage in investment grade has gone up. And it doesn't take much of a catalyst to spill over into investment grade, which then spills over into the entire capital structure. So let's take a look at your portfolios and where they sit as of Q4. So we remain underweight equities. We remain underweight U.S. equities. We remain more positive on international, both developed and emerging markets, and those bubbles have come down a little bit, and that's because of the denominator effect. So the whole plan obviously lost money in the fourth quarter, so if you just lower the denominator, then our overweights came away. And then the other place I want to talk about is treasuries. So we remain overweight treasuries, but again, it's in the very front end of the market. So your duration, let me slip to your duration charts. So this is your actual duration in the gray bar and the target duration in the circle in the blue circle. And each of these durations have increased anywhere from half a year with Burrs to almost 2 years with police. And that was due to a rebalancing we did in the end of December. So with the movement in markets, your equity portfolios obviously were worth less, your bond portfolios are worth more. So we took the opportunity to reduce your treasury holdings and increase your equity holdings. And what I've tried to show here, and I apologize, this is I don't even know what those shapes are called. But on the left-hand side is the actual. The right-hand side of this slide shows you where your equity portfolios would have been if we hadn't done the rebalancing on your behalf in late December. So despite the fall in the equity market, our rebalancing kept you about the same in terms of your underweight. And this is the same picture for your treasury portfolio. On the left is your actual overweights, and on the right is what it would have been if we hadn't done the rebalancing for you. So we did the rebalancing to stay within the rebalancing ranges to take advantage of the volatility in markets. Just wanted to share with you, what we did for you guys in late December.
Mike, just a question. In terms of the boxes, those are the rebalancing ranges, and you had just said that you're keeping us within the bounds, even though we're a little bit overweight or a little bit underweight, depending on treasuries or equities, from the target.
Yeah, the bars are the rebalancing ranges, and it's our responsibility to stay within those rebalancing ranges, and we will do that for you. That's all I got. So let me pause there for any questions before I turn it back over to John and Alex.
Any questions for Mike on the second part? Dave Kazansky.
So, Mike, what's your plan with the
duration with the treasuries going forward?
Spend a lot of time on it, and we're confused. So we're thinking about it in two different ways, both as a risk mitigant, and that speaks to that correlation between the growth part of your portfolio, as well as a standalone portfolio. And again, it's not real. If you buy into this as a regime shift, which I'm not completely there, it should mean lower yields, a steeper yield curve. And the key question is, when the steeper yield curve, does that mean the long end is up or down in yield? And it's just not real clear. I think it falls into what kind of inflation regime that we're in for the next, call it the year. So think of this: if inflation is going to be above target for the year, and the Fed is endorsing that, that means long yields higher. Conversely, if inflation goes below target, and that's not okay to the Fed, they're going to take action to try and get inflation up, and that probably means lower yields. And I think it's too early to tell. If you go back to December, we got that really weak manufacturing number, followed by a really strong employment number, and the bond market rallied right through it. And then in January, those numbers were both relatively strong. So early days, it's February 7th, but it looks like U.S. growth has decelerated from 3 to maybe only 2.5. But then you kind of wonder, is the change in financial conditions and some of these weak guidance, and you've seen some layoffs starting to get announced at an increasing pace, so are we going to continue to decelerate into 19? What's the impact, of all the, government stuff? Don't know. So we're spending a lot of time on it. And I would say, in the absence of compelling evidence, we go back to your strategic asset allocation, and that would argue for us to get there. And I'm just not comfortable with that either. So my guess would be that we're going to increase duration closer to your target, but maybe not out to 30s, maybe to 10s. But we've met every day, every week of since 19, trying to wrestle this to the ground. We're meeting again on Friday, and it's a big source of uncertainty.
Other questions for Mike? Okay, thanks a lot, Mike. Before we continue, just if trustees have arrived since roll call, if you could just introduce yourselves for the record.
Aldrin Bonilla, designee for the Manhattan Borough President Gail Brewer.
Martha Sabio, designee for Bronx Borough President Ruben Diaz Jr.
Alan Swisher for Queensborough President Melinda Katz.
Anybody else? Go, Kenny.
John Kelly from the UFA.
Okay.
Kenny Sparks, DEA for Mike Palladino.
Okay, thank you. Okay, Alex, do I call on Susanna here, or you got something more to say? Okay, Susanna, you want to take us to the next item on asset allocation?
Thanks, John. Good morning, everyone. On behalf of the controller, I wanted to speak to the asset allocation resolution that was submitted for consideration by all 5 pension fund boards. And the controller is asking his fellow trustees to approve the commencement of a strategic asset allocation study. As we all know, it is accepted best practice to review the asset allocation every 3 to 5 years, and the last study was undertaken in 2015 and approved by the boards in 2016. BAM and your consultants are in agreement that this is a good time to undertake this effort, and so we ask for your approval of the resolution that has been submitted to each board. BAM and consultants are here to answer any questions, and I look forward to a discussion now or during the individual caucuses.
Okay, thank you, Susanna. So does anybody want to make a comment here in the larger public session? And obviously, this will be on the agenda in each of the caucuses after lunch. Okay, great. So with that, we'll move on to the next item, which is Shachi Bhatt from BAM doing our annual compliance update. Welcome, Shachi.
So, as John just mentioned, my name is Shachi Bhatt. I'm the Chief Compliance Officer here for the Controller's Office. You know, I come every year to give you an update on the state of compliance. Think of the State of the Union, but just compliance. Much more fun. So, you know, I want to take you through everything that we've done in the last year, and, you know, as always, I entertain questions and comments. So first I'd like to introduce my team. This is the same team that you saw when I came in May. Sonia Cowan, a senior compliance analyst, has been with the office since 2015. Susan Ree joined in 2016, and Mara Zaldanis joined last year. I think it's a very cohesive team. We work really well together. Everyone is cross-trained on all major functions, so we think that's just great for continuity. So if you remember way back in May, I came to you with some of the initiatives and things that we were supposed to be working on for 2018. They included enhanced training, you know, better reporting, and better, I guess, enhanced and more detailed manager compliance due diligence. Happy to report that all of those things we've checked off our list, and we've implemented policies, procedures, processes in our group to execute those. We'll go through them in a minute. And then I also want to give you an update on the annual compliance and ethics questionnaire, which is an ongoing thing. Okay. So we hit training a couple of different ways last year. You know, we had in-person training. We had the Conflicts of Interest training, which was hosted by the Conflicts of Interest Board. Similar to prior years, we really tailor it to all things investment related. You know, we talk about conflicts that the BAM staff might have with investment managers or, you know, industry events and such. So we really want to tailor it to exactly what BAM's needs are, and I think we were successful. All employees in BAM and several employees in OGC, in our Office of General Counsel, also attended. Last quarter, we launched a new variation of fiduciary training. It was highly interactive. We had lots of scenarios, imaginary scenarios of, you know, what people could do in a conflict. If they're faced with a fiduciary-related conflict, how would they work that out? You know, what are the steps that they should take? We offered it much more broadly than the Bureau of Asset Management. We had BAM, we had the entire Office of General Counsel, we had the Bureau of Accountancy, and we thought that just having that broad reach was really important, and I think we found it to be successful. You know, we had a lot of great discussions, and we thought the interactive component was helpful. We continue to enhance new employee compliance training. You know, we day one, they have to come and sit with me and learn about the personal trading policy, what the ban on placement agents is all about, you know, what their fiduciary responsibilities are, just the components of all of the boards, just to get everybody off on the right foot and set them up for success in BAM. I think last year we had about 18 new employees go through the training, as well as I think 10 interns. They go through a more abbreviated version of the training as interns might. And then last but not least, we also offer a compliance newsletter quarterly. So this is a little bit more of an outreach. So every couple of months we send out I like to think it's very fun, compliance-focused newsletter that talks about just different things that are happening in the industry. Perhaps the SEC chairman made remarks. We share those with employees. Just new topics that our investment managers are very focused on, like cybersecurity. And then again, just helpful reminders about different internal policies and procedures. And that goes to everybody. It's a broad distribution list in our bureau. Okay. So one of the reporting enhancements that we undertook last year was we continued the process of moving all of the investment guideline monitoring processes from a monthly oversight to daily. The reason this is meaningful is we get to see what the portfolio managers are trading on a day-to-day basis. So if there is a potential breach in a portfolio, we would know, the very next day versus, a couple weeks later. Thankfully, these are very few and far between instances. But we think it's an important process to move just for the purposes of transparency and just being more aware and on top of your portfolios. In 2018 alone, we implemented about 2,700 individual rules that are run through our State Street compliance monitoring system. It's a pretty meaningful amount. It was a big lift for the team as far as helping to code and make sure that all of the, calculations were done correctly. So because of that, we were able to implement quarterly trustee reporting. So we started this in September, where we reflected the second quarter activity. When a breach, for example, if a board were to divest from a particular security or has some sort of other limitation or restriction on the portfolio, those are all coded in the system. When those are detected by the compliance software, we immediately spring into action with both the investment strategy teams as well as our investment operations support team, and we all work together to make sure A, the breach is corrected, and B, in the event that there's a loss to the portfolio, it's promptly addressed and the fund or the system is made whole. And then you should have seen them in your quarterly books. You'll see one next month in the March materials. We put together a report with all of the summaries of the potential breach or of the breaches and the resolutions. So we hope that that's helpful reporting. Happy to get feedback if there's other things that you think you would like to see within that component.
Okay, comments or questions for Shachi?
I have a couple more slides.
Oh, sorry, I thought you were...
All right.
I apologize. I was
Note
jumping the gun.
taken. Wow. All right, John. Okay, I'm going to go real fast now. Okay.
I'm sorry.
No,
Sorry,
I'm
Shachi.
just kidding. It's fine. It's fine. So we're in the home stretch. We also enhanced the compliance portion of our due diligence process. I'm going to address the last two bullet points first. The investment strategy teams have been really exceptional in looping us in with any regulatory related findings or questions. And so we've been able to really roll up our sleeves and be helpful in identifying what we think is appropriate for managers. Sometimes we'll do calls if we think that there is something that we need more clarification on. We also internally have upped our analysis of all employees of investment managers that the systems either work with or are considering. We look at all of their campaign contributions against the New York City Campaign Finance Database to make sure that they are indeed complying with the SEC's pay-to-play rules. And then BAM participated in ILPA's working group, and that was tailored around, enhancements in their due diligence process, and we offered our best practices as far as diversity and inclusion. And in the third quarter of last year, ILPA issued a new due diligence questionnaire to all of their members, which had a lot of, I believe, our feedback built in. So, I wanted to thank the private equity team for their contribution and participation in that. We think the questions are just more thoughtful or we've put them into place in third quarter, and so we think we're getting better, more thoughtful responses from managers. Along the same lines, we noticed, or we worked with the hedge funds group to identify sort of a gap in the industry-wide due diligence questionnaire, and we created one that we think better fits the needs for the systems invested in hedge funds. So that questionnaire has been in effect for several quarters now. So happy to have been able to enhance our due diligence process. The annual compliance and ethics questionnaire, I've mentioned this in prior updates. It is about a 45 question questionnaire that goes to all public and private market managers. It is a mandatory filing for public market managers, and it's voluntary for private markets. I can say that since I've arrived, we've seen participation on the private market side increase quite a bit. So we are getting more and more participation from the managers that we work with, which we think is great. There's the questions that we ask are designed to give us even more transparency into each of these firms' compliance programs. And in 2018, some of the updates that we made reflected updates in the European regulatory environment where many of our managers do business. Okay, last but not least, for 2019, as we look forward to this year, we continue our efforts to train and educate staff on everything that, all things investment related as far as compliance goes. We are taking another look at all of our internal processes to find opportunities for automating tasks, applying technology where we can, et cetera. And then, as always, we continue to kind of enhance and develop our own policies and procedures so that, we're holding ourselves to the same high standards as we do everybody else. So now I will pause for questions. If you have questions on any of the material that we also offered in the executive appendix, I will be sticking around right here. So.
Any questions here in public session? Mr. Kazansky.
Shashi, so I recall reading in the memo that there was, that ILPA in their questionnaire had really built out some more questions and probing on diversity and on sexual harassment in the workplace.
Mm-hmm.
Where is that information, or how much of that information is going to make its way into the memos that we see when we're making decisions on managers here? And that may be more of a question.
Yeah,
for
I mean,
Alex
I was going to say I'm going to now turn it to Alex for his thoughts. I think it's something we're discussing internally. These questionnaires are now just starting to come back, so there is a little bit of how do we process this data and push it back out.
So to touch on that, then maybe it would be helpful that the questionnaires or copies of the questionnaire forms be sent to the trustees so that we can see what may be addressed, what may not be addressed. Maybe we can see something that you've missed on the questionnaires. We could add what we want to see addressed on them. So I think it would be helpful just to have a copy of the questionnaire itself, and the forms. Would that be helpful?
Joe, are you talking about, may I ask, are you talking about our internal due diligence questionnaire or the ILPA
the
template?
question, the internal questionnaires that we're sending out, that they're filling out, we should be able to see what questions are being asked, maybe what we'd like to see maybe addressed. Maybe also, if you want the ILPA, I think that's online anyway, but at least we can compare it.
Why don't we start by circulating the ILPA and the BAM due diligence questionnaires, and then we can have a conversation with trustees. We're happy to do that.
Yeah, that's all I'm saying. Is you want to be able to see if it's being addressed. Maybe there are ideas that people have here that they would like to see on the internal questionnaire that we'd like to see the managers answer.
Sure, I put a note, so I'll circulate it through the pensions team.
Yeah.
And I would just add, David, to your question, it really depends on what the responses are to those questions as to whether it makes it to the memo. So obviously, to the extent that it is a consideration that was raised, even if it was mitigated, you would expect to see that raised and mitigated as part of the investment considerations of the memo. But certainly, there wouldn't be a comment necessarily if there was nothing to report in the memos. But we're still, thinking through that.
Well,
Go ahead, Dave.
Just to build on that, I think there are some issues, like diversity, for example, that get brought up every time. And even looking at the managers that are being presented to us today, in the memos that were provided, the diversity section in the reports are vastly different. And so there really does need to be consistency, if at all possible, and I know that a lot of it is based on the information that is willingly handed over, right? But I think that there's a need for us to at least have some level of consistency in what we get. There was one manager where we saw breakdowns in percentage of hires and so on and so forth, and then with another manager, it was, yeah, diversity is great. So I think that discrepancy is something that we really need to kind of figure out a way to address in future memos. And maybe the OPA questionnaire or our own internal one is a way to address it.
I would add, David, that I think certainly I was more referencing to some of the newer questions and specific questions of the questionnaire on sexual harassment in those areas, which may or may not make it to the memo if the teams don't believe there's a need for it. Obviously, if there is a problem, that would be raised. On diversity specifically, that's an area that we are looking to study internally as to how we more standardize the information that is presented to the trustees in the memos. So there we are looking to have a standard template and presentation. One of the things we've urged managers, as you can see, and this came at the request of one of your fellow trustees about a year or so ago, is to have all managers address diversity in their presentations to you. So we've asked them all to create a slide to address it. But you're right, we get different levels of information, but we will work towards find a way to standardize what's presented to you all in the memos going forward.
Other questions for Shachi? Yes, Aldrin. Aldrin Bonilla.
The standardized template answers the first question I had. The second question, in terms of for public markets, the response to the questionnaire of ethics and compliance being mandatory, does that mean there's 100% response?
Yes.
Okay.
Yes.
And for private markets, you mentioned that there's been an improvement. Does that mean it goes from 10% response to 20, or is it from 20 to 25? Like what's the
I think
response
it's
for the private markets?
significantly higher than that. I think it's closer to 85% completed for private market. 100% for sure for public markets. I think it's probably 80 to 85% of private markets.
Thank you.
And Sachi, are the ones that aren't complying, are those mostly our runoff managers?
Yeah, almost, yes. Yes, they are.
So we're no longer making new commitments to managers that do not comply. Is that correct? I know that's true on the OPA template, but it's true on the rest of the
I think
compliance.
technically the way I would state that is that 100% of our managers that are primary managers are responding to this template.
Well, I understand that, but if for example, there's a manager coming in today that's a new manager, we wouldn't consider that new manager if it hadn't filled out the compliance questionnaire. Is that an accurate
The
statement?
compliance questionnaire goes out in May of every year. It's an annual launch. So if there was a new manager, for example, in your example today, we would absolutely expect them to participate when the questionnaire comes out in May.
Yeah, I'll say that it's existing managers that answer the annual compliance questionnaire, and it's new managers that fill out the due diligence questionnaires and the ILPA template. So new managers haven't had the opportunity to fill out the annual compliance questionnaire. That happens after they've been chosen, but we would never consider a manager that was not filling out the required paperwork to be diligenced and reviewed by BAM.
And just to add on that point that Susanna made, when we look at managers on the front end, the new managers before they are even recommended, all of the questions that we would ask annually, we ask them during the due diligence process.
Thank you. That's clarifying.
Yeah.
Thank you, Shachi.
Yeah.
Other questions for Shachi? Great. Thank you, Shachi.
Thanks.
Okay. Alex, that does it for you and your team, right?
Yes, it does.
Okay. Before we entertain motions to exit public session, I just wanted to make sure folks know, I believe by email, a sign-on letter with ILPA that we just talked about, the Institutional Limited Partners Association, to the SEC for pension funds was circulated to everybody, and that will be addressed in the caucuses today. It's a letter to the SEC that urges the SEC to essentially not weaken the fiduciary protections that are required in limited partnership agreements for investors. And there's about a couple of dozen or so of our peer pension funds that have signed on to this letter. We're essentially requesting, Alex, did you want to address that?
I wanted to add, John, that BAM, together with OGC, has reviewed this letter.
Yeah.
It is largely consistent with what we and this letter, and it's obviously up for your consideration in caucus. This letter, and it's obviously up for your consideration in caucus.
Okay.
Mr. Facilitator?
Yes, sir. Mr.
There was
Officer Alejandro.
One item I requested about a meeting ago, which was on the corpus positions and the monies that have been expensed for the positions. Do you have that info for this meeting?
I do not have that for this meeting. We'll continue to work on that.
Okay, do you have an
Alex,
idea when I'll be getting it?
Yeah, I'll just say Alex actually gave me a draft, so it's totally on me, and I'll be turning it around in the next couple of days.
Okay, thank you.
Okay. Okay, with that, that concludes our public agenda for this morning, and we will now entertain motions from each board to enter executive session. So let me start at NYSERS. Is there a motion to enter executive session at NYSERS? So moved. Thank you, Mr. Katzman. Is there a second? Second. Thank you, Mr. Johnson. Any discussion? All in favor of the motion to exit public session and enter executive session at NYSERS, please say aye. Aye. All opposed, please say nay. Any abstentions? Motion carries. Next, at Teachers, is there a motion to enter executive session at Teachers?
So moved.
Thank you, Mr. Kazansky. Is there a second?
Second.
Thank you, Mr. Brown. Any discussion? All in favor of the motion at Teachers to exit public session and enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Next, at Police, is there a motion to exit public session and enter executive session? He's jumping the gun, so to speak. Who was that? Who made the motion? Oh, yeah, Mr. Conroy, thank you.
Second.
And Mr. Dorset makes the second. Sorry, Officer Alejandro.
That's all right.
Please don't take it out on them. Yeah. Any discussion?
Trying to move it along.
I'm trying to. All in favor of the motion at Police to exit public session, enter executive session, please say aye. Aye. All opposed, please say nay. Any abstentions? Motion carries. And at Fire, is there a motion to exit public session and enter executive session?
So moved.
Thank you, Mr. McGinnis. Is there a second?
Second.
I saw Mr. Brown, so I'm going to give it to Mr. Brown. Oh, you're both, Mr. Brown or Ms. Brown, right?
That was
Okay.
very disrespectful.
All right, well, the motion is by Brown. Okay. The second is by
You're
Brown.
not very diverse on that.
Too much joking around this one. Okay, we have a motion made and seconded at Fire. All in favor of the motion to exit public session and enter executive session, please say aye. Aye. All opposed, please say nay. Any abstentions? Okay, motion carries at Fire. We have now exited public session and entered executive session at all the boards. I'd ask any members of the public and the media to please exit the room.
During the executive session, the board discussed various investment matters, reviewed personnel decisions, and also made decisions about which candidates to hire. We now need a motion to adjourn.
So moved.
Second.
Any discussion on the motion? Hearing none.